Good morning. This is Craig Moddelmog with Cornerstone Wealth Management, and this is this week's Wall Street X's and O's. It is Friday, October 18th. Hard to believe we're already halfway through October. I'm always amazed at how fast time goes. I'm still getting over 2018 being done, and here we are almost through 2019. So really adds some clarity of making the most of every day because time is going to fly, whether it's good or bad, right? So anyway, hope everyone is doing great. Throw out my normal disclosure or disclaimer here. Obviously, all investment products that we discuss do have costs. They can gain money, they can lose money. They are not FDIC insured. These are basically my thoughts. They are not a request to do any action, buying, selling, anything. This is mainly an educational video blog that I hope is helpful and also a little bit fun. So anyway, kick things off here. Bronco fans, did you ever think you were going to say, I'm really glad we have the Nuggets? Wow. It is what it is. John Elway, you know what? It's one thing to be on the field and be good. It's another thing to be in the front office and not be good. So pressure's on John Elway. We're going to see how John does because right now the Broncos are bad. And it is what it is. Off my soapbox. I'm not going to say any more. Anyway, on to the markets. I've got a few comments on low interest rates and the impacts here. First of all, low interest rates are good for governments because it decreases their borrowing costs, means they owe less interest, okay? So when you have our federal government, where we've got today a 10-year treasury at 1.75%, a 30-year at 2.24%, our borrowing costs as a country are very low, okay? It also means borrowing costs for corporations are low. So when you look at this from a governmental standpoint, it is good because borrowing costs are cheap. From a corporate standpoint, if you want to know why growth has outperformed value for the last decade, it's been cheap for companies to borrow money. It also makes it easy for people to speculate on what is going to happen that may not have happened in the past because companies can throw money at debt, in which we've seen corporate debt expand significantly. We've seen high yield debt expand significantly. Why? Borrowing costs are cheap, okay? This is not a good long-term event. We've seen that in Japan. If you go back to Japan in the 80s, Japan's market was ripping and roaring. Everyone thought Japan was going to conquer the world. The Nikkei peaked out at almost 40,000. 30 years later, do you know where the Nikkei is at today? Around 22. Did that work too well? I don't think so. If you look at Europe, Europe has been on a huge binge on low and negative interest rates as well. They're starting to figure out today, I was reading this morning that the European Union is starting to look at other options. Wow, it took you 10 years to get there. Congratulations. You know, the average individual doesn't have 10 years. That's why this crap makes me, not sure well, I can say crap, it's my show. Anyway, I'm not sure this crap makes any sense to people. In regarding what low rates do. From a standpoint of money market rates, if you think about this, we've had a decade of very low money market rates. If you think about this, if you have a money market rate at 1%, okay, we have inflation at 2%, are you making any money? The answer is no. It forces people to speculate. It forces people to put money in other places where they probably shouldn't. This is a bad thing. I've spent 4 minutes on this now, and I told myself I was only going to spend 2. So anyway, I get fired up on this stuff. On to the markets here. Here's what's interesting. Stocks and bonds are in a wrestling match. Ned Davis, who is my research group, tracks the relationship to stocks and bonds, and essentially we are in a period of time where for the last 39 weeks, stocks and bonds have been wrestling within 5% of their 1-year average relationship, which is the longest period in 25 years. Now, what does that mean? Well, What it means is that we are coming to an inflection point to where, as an asset allocator or as a money manager, you wonder, how is that going to impact us going forwards? It's like this. If you have a rubber band, and you're going to love my little demonstration here, and you tie a pencil, remember doing this in grade school, where you would twist this sucker up and then you would let it go and it'd flop around and always hit someone in the eye, right? That's the kid that got in trouble and had to sit in the corner. Not to say that ever happened to me, but I've seen it happen, okay? From an economic standpoint, the rubber band is twisting, okay? We are on 37 weeks of the stock and bond market going through a tug of war. You know what happens inevitably? Something is going to pop, okay? What this means is the next breakout, whether it's to the top side or to the bottom side, is probably going to be a doozy, okay? How do you prepare for that? Number one, you don't guess. Okay, you stick with good fundamental asset allocation. You focus on high quality, both on the equity side, the stock side, as well as the bond side. You wait for confirmation, okay? If the market deteriorates, it's going to fall apart. You know what? Because you haven't been guessing and getting overweight in equities, you are not going to get hurt, okay? And you adjust accordingly. If we happen to reignite and the economy starts to grow again, guess what? It's easier to roll into equities than roll out of an overweight in equity position. So, in closing today, what's going to happen? I have no clue. No one has a clue, okay? So don't buy the clues that are out there. That is garbage, okay? What we need to focus on is good, solid asset allocation. Right now, I am very equal weight, both on the equity side and the bond side, meaning I'm not making any bets that the market's going up. I'm not making any bets the market's going down. So we are going to be patient, and we are going to wait for that pitcher to hang the curveball, okay? I can never hit the curveball. That's why I just played high school ball. But we are going to sit back. We are going to be patient, people. So anyway, I appreciate you joining me today. Wall Street X's and O's. This is Craig Moddelmog on October 18th, and I am out.